it has always been difficult for small and micro-sized companies, especially startups, to get a loan, as they usually lack collateral security and have higher operational risks. And as they are just starting up, they may also find it tough to acquire venture capital. But now, there's another path for them: the investment and loan linkage. Financial institutions offering these loans usually invest in a company's long-term equity income instead of relying on collateral. And that allows them a way to provide financing for medium, small, and micro-sized companies at relatively low interest rates. With 250 employees, this container truck fleet service provider has seen its revenue jumped 200-fold since it started up in Shanghai's Zhangjiang high-tech city 4 years ago. It was easy funding from a finance firm in the area that allowed the company to grow fast.
In 2017, we got our loan when we had only been operating for less than half a year, 500,000 yuan. Then we soon got a deal of more than 10 million yuan through the investment loan linkage. According to the normal procedures of China's commercial banks, for a company that has just started for less than a year, it would have been almost impossible to get a loan.
Specializing in financial support for tech startups, Shanghai Zhangjiang Technology Microfinance Company has utilized the investment loan model to serve 20 companies. Compared to its traditional loan models, the fixed interest rate of the investment loan model is 30% less, at around 8% per year. The rest of the returns come from the growing valuation of a successful startup. Of course, this means the finance firm needs to be pretty sure about the future prospects of the company applying for the loan.
First, we select companies in China's 3 key industries: bioscience, information technology, and artificial intelligence. Then, we contact our investment firms, as we have a large number of leading funding institutions here. They have really rich experience in investing in startups. They value the future prospects of the companies based on equity financing.
The startups the finance company supported have given it an average of annual return rate of 12 to 14%. China has been encouraging investment loan linkages since 2016, when it approved 10 banks to try the scheme. But experts say there is still ways to go for major commercial banks to get fully involved.
At the moment, the risk of a loan is a personal responsibility of the staff who approve the loan, but the income is for the whole bank. So the risks and the reward do not match, and based on the current evaluation and risk management system that state-owned commercial banks use, they are more willing to do projects that offer stable income and fast returns.
Zhong suggests the government could help the situation by offering investment risk guarantee funds to banks so as to share the risks of investing in startups. If the investment loan mechanism could be more widely implemented, he says, it would help the banking sector break its traditional heavy reliance on lending for net interest margins, which would also increase the profits of the banking sector. Zhang Shixuan Money Talks.